Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
I think we're good.
We're good. Okay. Thanks again, everybody, for being patient with us. We're having some audio issues. We're here with Ryan Detrick from Schaefer's Investment Research, and he's going to discuss the importance of incorporating sentiment when trading ETFs. So just a little background on Ryan. He is the Senior Technical Strategist at Schaefer's with over a decade of experience in financial services and investments. His areas of expertise include short-term trading with an eye towards timely technical and sentiment-based opportunities and advanced options trading strategies. He's a frequent guest on CNBC and Fox Business and has been quoted by various print publications including Bloomberg, Reuters, and Financial Times. So thanks again for bearing with us, and thanks, Ryan, for being here, and I'm going to turn it over to you. Thank you.
Hey, thank you. And yes, again, I apologize for little technical difficulties, but we're starting a few minutes late, but not too bad here, I guess. And again, this is the importance of incorporating sentiment when trading ETFs. And my name is Ryan Detrick. I'm the Senior Technical Strategist with Schaefer's Investment Research. A quote by Pt1. My dad said a fool with a plan can beat a genius with no plan. And as with life and in general with trading, I think it really makes sense when you look at this quote and think about it. We all need to have a plan. And when you talk about trading, I think it's really neat that we have a lot of people actually listening to this presentation right now. And obviously a lot more people out there in the world that are trying to invest and accumulate wealth. And it makes sense that we need to have a plan. If we just look at the market and don't really know what we're doing and look at the headlines and trade whatever is the hot stock or the hot sector, that's probably not the best way to make money. But when you take a step back and you focus and you actually have a plan, I think without question we're at a huge advantage versus a lot of other people out there. So with that, I will say that we have an award-winning website, schaefersresearch.com. And just, for those of you who have never heard of Schaefer's, our CEO, Bernie Schaefer, started the company about 30 years ago. We are one of the world's largest options newsletters. We focus in the world of options. Specifically, we follow a little bit of everything. And what we definitely focus on is sentiment, much like what I'm talking about in this presentation here. Now, the wisdom of the Great Sanhedrin. The Great Sanhedrin was, I guess you would call it the Supreme Court of ancient Jerusalem about 2,000 years ago. And the way it worked was there were 71 judges, and every day, except for the holy days, they would get together and they would talk about whatever the issues were, and they would vote on the issues in the kingdom at that time. Now, what's interesting about it is, of course, they'd vote and they'd make their decisions. But if all 71 judges actually agreed on something, then they would immediately throw it out. And it's interesting because I think that makes a lot of sense as you look back in history right now. When a lot of people agree on something, there could be an extreme, and that could be actually a time that you don't want to go against the crowd. So it's interesting. 2,000 years ago, the Great Sanhedrin knew this. And it's fascinating because as I'm going to present to you in 45 minutes or so, it still makes sense. When everyone in a room or in a crowd agrees on something, you really want to probably say that or go opposite that. Expectational analysis. Expectational analysis is everything we stand for at Schaefer's Investment Research. It's what Bernie Schaefer has been working on for 30 years now. And it's equal three parts: fundamentals, technicals, and sentiment. And everyone out there trading probably uses fundamentals and technicals. But what we incorporate, again, is sentiment. We think it's kind of the third leg to successful trading over time. Now, getting into these three legs, let's talk a little bit about each of them. When it comes to fundamentals, we follow really a lot of the same things that a lot of other people do. what we talked about is earnings growth. Now, what's interesting right now in the stock market, we've been bullish for a while. I do apologize. I guess the audio is muffled, and I am using a cell phone, so I'm sorry. I'm trying to hold the phone straight, and I'm trying to talk loud. I guess I'm sorry if it's not coming in too good. But when you talk about earnings right now, what we've been noticing in the market is, we're expected to have record earnings this year. Yet, if you look at the overall sentiment, in our opinion, it's still a little negative. So we kind of like that kind of skepticism in the face of strong price action. And again, when you have record earnings coming out, if you just do some simple math, the earnings are expected to be around $100 this year. A forward PE of 15, which is around the long-term moving average, or long-term PE average of 15, that equates to an S&P price of 1,500. So we don't think that's too extreme at all to have them move up to 1,500 probably before the end of the year. Dividends, when it comes to trading in general, we don't do too much in those. We do a lot of shorter-term trades and option trades. So dividends, they aren't such a big deal to us. Nonetheless, it's something to be considering. Earnings revisions, this is a huge one. We love to do stocks in general that have earnings and they gap higher on higher earnings, or potentially lower if the earnings were lower. And we like trading around events because clearly that can show there's a lot of room for volatility in the near term. New products and new management. The perfect example here, of course, is Apple with all of the various products they've had over the years. They can be very powerful, as we've seen, and you have some good products, or vice versa, some negative products. Look at Research in Motion recently with their latest tablet. It's got some negative press, and the shares have kind of been hit, so to speak. So, from the negative point of view, you can have negative fundamentals that can hurt the shares. And then it's supply and demand, like it says. I guess this works probably best with the commodity world. As we all know, commodities lately have been going parabolic, specifically with the silver. Nonetheless, that's where that really comes in handy there. Some other areas of fundamentals that we do like to look at, if you look at M&A activity in general has been extremely strong. And it's really, we think, a very positive for the overall stock market. If companies are willing to pay more premium for lower-priced companies, that can be very positive for the overall price action of the overall stock market. Also, share buybacks have been very strong. Share buybacks have just, they've been strong. So, again, that's positive on the fundamental front in the credit market. And if you look at really credit markets in general, they've been leading us higher for 2 years now. And with the credit markets doing well for 2 years, we still think those credit markets are continuing to look strong. That should be positive, really, for the overall stock market here. Technicals. With technicals, in general, they are looking at past price action to determine future price movement. And we use mainly a lot of the common ones a lot of other people do. We look at moving averages, the various moving averages. Gaps. Gaps are one of my favorite ways to trade. Again, I love to see when the shares gap higher, maybe consolidate sideways to lower after that gap, and the gap was due to some type of a positive fundamental reason. Gaps can be very powerful, and we've done some studies, and we found actually gaps are one of the more positive, or I guess I should say better trading mechanisms when it comes to technicals. So gaps are strong, and you should definitely look to play those. Volume, I'll be honest, volume probably isn't as important as it once was, and with all the computers that are trading against each other, this is kind of why we think, there really is about half as many hedge funds as there were, 3 or 4 years ago. Nonetheless, this is kind of why volume's been light. Really, in general, volume isn't as important, but you still should pay attention to it. And then lastly, relative strength. We're big on, mean reversion is not the way to trade. We think that stocks are outperforming amongst negativity That's a real positive, and it continues to soar and continue to do very, very well. So we love to play the relative strength leaders that a lot of other people are skeptical on, or kind of saying they're due to pull back, it's due to pull back. Those are areas we definitely think there's a lot of opportunity. And lastly, as I said, sentiment. This is the third leg to our trading philosophy of Schaefer's. If you look at sentiment, some of the various things we look for: put to call ratios. As we all know, puts are bearish bets in the options market, calls are bullish bets. Without question, what we look for upward price action on stocks or ETFs that have, a large put to call ratio. Interestingly enough, Boeing is a name that has earnings tomorrow morning. And what we've noticed with Boeing specifically is there have been a lot of calls, a lot of bullish bets on Boeing. At the same time, that fourth one is anecdotal sentiment. And what that means is, magazine covers or what you hear on TV, what you read. Back to Boeing, there was a bullish Barron's cover story just 2 weeks ago on Boeing. So you've got lots of calls trading on Boeing, a bullish article. On take is that's not necessarily bearish for Boeing, but it very well could be a sign that there's extremely high optimism on Boeing. And should their earnings tomorrow come in poor or just a little bit off, the shares could be punished more so, given there's so many high expectations, we think, for Boeing. Short interest is just exactly that. Shorts, of course, are bearish bets. What we're looking for are the sectors that are continually improving, and as the shorts also increase their bearish bets. There's nothing wrong, look at silver. Silver's had a tremendous run. We look at the SLV, the silver ETF, and the entire run that silver's had, really a spectacular run they've had the last couple months. Short interest has continued to increase. So we think that's a good sign that there's a lot of negativity on silver, and people keep betting against it. And I know silver's pulled back recently, but for the most part, you can make a lot of money on silver the last few weeks. The short interest continues to soar. And finally, analyst ratings. This is another good sentiment gauge we use on various sectors or specific stocks. If you have a sector that's outperforming, a good example would be restaurant stocks. We have a database, and we keep track of analyst buy, sell, hold ratings. And interestingly, restaurant stocks has done very, very well in general, very strong price action, positive fundamentals. Yet if you look at the analyst ratings, there are not that, well, there are some buys and holds, but really it's not as high as you think. There are a good amount of holds and actually some sells on some restaurant stocks. So to us, you have that strong price action and the analyst community that simply has not caught on. That's potentially a contrarian bullish play. Think like a cinematician. This is a neat little word that we've made up. Cheap can always become cheaper. So many times we hear stocks are low, they're priced low, things are a good value out there. They can continue to go lower. And that's why it's important, we think, to look at sentiment. If you look at the XLF, the financial ETF, from back in 2008, back during the financial crisis, on the way down, we noticed the XLF continued to have calls traded on it. There was continued bullish bets on financials. And the whole way down, as we saw the bullish bets, there were arguments that financials were fairly valued and there are some good values out there. Yet the sentiment to us was simply too bullish in the face of a negative price action on financials in general, financial ETFs. And for that reason, financials continued to drop. That's a good way to look at how we look at sentiment. The second bullet, look for stocks or ETFs that have low expectations, therefore avoiding the crowd. The next one, low expectations translate into potential buying power. Again, this is what I've been talking about when we look at various sectors. If you have the strong price action with the lowered expectation, it very well can mean there's a lot of money left on the sidelines. Again, if you look at right now, one sector that we really do like is small caps. Small caps have done very well. The last 10 years, really, the Russell 2000 has led this market higher. The last 10 years, the Russell 2000's it's up, I think, about 85% versus the Dow Jones over the past years, which is up about 15%. And the last 2 years, since the market bottom in March 09, the Russell 2000 again has been leading it. Shed, what do we hear when you listen to what a lot of the analysts tell you? They pound the table for the big blue chip names, big defense names. Those are the ones you want to be in. And we've heard that for almost 2 years now. And to us, with that strong price action in the small cap names and in the mid cap names, there's I keep seeing notes that people say the sound is not working, so I apologize for that. But with the small caps and mid caps leading us, we think that's a new contrarian play. Historically, when small caps and mid caps lead, that's a really good sign for the overall stock market. So to us, that as long as we keep seeing that negativity and the small caps leading, today the Russell 2000 broke above 850, and that 850 level that was resistance back in 07. So we think there's lowered expectations in small caps and mid caps, and that's bullish for us. Lastly, success comes from buying low expectations, not low prices. And again, that sums up everything I've probably just been talking about. The life cycle of a stock. Now, this is a longer-term view on how we look at things. When things bottom, I guess obviously the best example is a few years ago, March 09. There is total despair. And during that time frame, everyone throws their hands up and they don't want anything to do with the stock market, and that's how bottoms form. And then on the way up, you have some disbelief. People simply can't believe the market's going higher. And eventually you work your way to acceptance, and that's when you accept the fact things are higher, and that can be the longest time frame. But really most of the spectacular gains are done during despair and disbelief. But acceptance, a lot of money can work its way in. And then, of course, with euphoria, as we all know, euphoria is when things tend to peak, but euphoria can last usually a lot longer than most people expect also. When I look at this chart, the thing that I always think of, and where we think we are in the market right now at Schaefer's, is we're probably somewhere in between the disbelief and the acceptance stage. Now, there is definite signs of acceptance coming in, but when you look at what people are doing with their mutual funds, the last 3 years, there's been net outflows on equity mutual funds. So you could say some of the sentiment indicators and sentiment polls that are out there, people are bullish, and very true, but what are they doing with their money? They really aren't putting their money to work, we don't think. So for that reason, there's still some disbelief in our opinion. An interesting stat, after the flash crash, almost a year ago now, last May, after the flash crash, there were 33 straight weeks of equity mutual fund outflows. And almost over $100 billion of money were taken out of equity mutual funds. The first quarter of this year, and again, the first quarter was the best first quarter we've seen, I believe, in 11 years. There was only $15 billion put into equity mutual funds. So again, just a small drop in the hat. And at Schaefer's, we've been saying for a while, this is a very bullish contrary sign that money simply is not going into the stock market here, but the stock market without question is going higher. So that's a very good sign. Now, a lot of people like to talk in this world, or right now, kind of the metals. That's where the action is with gold and with silver. And there's no question they are in the acceptance stage at this point. We don't think we're quite in the euphoria stage yet when it comes to metals. An interesting little stat on this, and the reason we think it, the market cap on Apple currently is about $325 billion. Now, the market cap on the 10 largest publicly traded gold companies isn't even over $300 billion. So, yes, metals have had a tremendous run. Nonetheless, we still think there could be some potential explosive gains still in the metals world. And again, when you look at the market caps on the metal names, we don't think it's anywhere near where previous peaks have been formed. A good example of how we trade, it's an actual trade that I did just 2 weeks ago. And again, I know this is on JP Morgan, and this is an ETF presentation, but I think it kind of hammers home how we look at things. Technically speaking, You can see J.P. Morgan here. You can see the blue line. It was definitely, it was a gap area right there. It filled that gap. So technically you could say there's some levels of resistance potentially. Now what I liked about this trade is J.P. Morgan had earnings. As we know, we're during earnings season here. And their earnings were considered great. It was all over the headlines how wonderful J.P. Morgan's earnings were. And that's fine. But interestingly enough, what happened was the shares gapped higher by about 945, 950. The shares actually were in the red. So you kind of got an inverse with what the overall sentiment was. And as I said, they filled that gap from February. There are huge calls at the 47 strike in the April series. Now we can go to that right here. This is what I'm talking about. You can see the largest blue line was the April series. The 47 strike was the highest peak calls, and again, calls are bullish bets. So when you see a lot of people betting it go above 47, you can see here on the chart it went to 47 the day of earnings and kind of reversed. So there's a lot of bets that are wrong. And we like that when we see that. Lastly, options were very cheap. This is encouraging from an options point of view, and you can see here, this is what this is the VIX of J.P. Morgan. And as we all know, when the VIX is low, it suggests there are cheap options. So what we liked about it was there were earnings coming up, and there were very cheap options. This is a very positive sign, we think. So it all made sense to buy puts on J.P. Morgan. And we did that. And fortunately, of course, this is a good example because it worked. And, of course, all trades don't always work. But you can see here we did where the green circle is when we purchased the puts. And the shares went lower. And the bottom line is the price action looked good. The fundamentals were quote-unquote good. But the sentiment got, we think, a little too ahead of itself. And the shares had a pretty decent-sized drop the next few days. And on our options, we turned about an 80% profit in just a few days. Pays to keep it simple. One of my favorite indicators is the MACD histogram, and you can see that at the lower, at the bottom of this chart. It's amazing at how this is the S&P 500 long-term chart, and when the S&P 500 MACD histogram turned green in early 03, that was very, very close to the lows of 03. It stayed bullish till late 07. I believe it was December 07 when that gram turned negative again. And you can see you had a very spectacular rally, and it came very close to nailing the actual peak. And then once it turned negative, all bets are off, and the market had a spectacular crash. And as long as you stayed listening to the histogram and stayed bearish, you did very well. It turned bullish again in the middle of 09, and really since then we've had a very, very nice rally. And for the time being, as of now, you can see that histogram is still comfortably in the green, and it probably says overall this market will keep going higher. Now I like to also use this when I'm trading ETFs because, again, I think like it says, it pays to keep it simple. And when you listen to this and look at these charts, we all get into listening to the overall market, listen to all the news, but sometimes you take a bigger step back and look at a monthly chart like this, you get the overall trend, and as they say, the trend is your friend. It's kind of cliche. Nonetheless, when you see something powerful like this, it makes sense to look at these longer-term trends.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.